see my screen?
I can.
Here we go. Did you see that change, everyone? Thanks everybody for being part of this call today. We'll get into that. This is a special anniversary month for me as far as being into this business. We'll have some fun quizzes. We're going to give away up to $40,000 worth of research today to different people. So I just want to start off with this and say a big thanks. Several years ago, I started up the idea that I wanted to just try to help people around the world. After speaking with Sir John Templeton, I had a financial planning practice. I said I wanted to help more people, and he said, well, this is the way that you could do it. But none of this would be possible without each of you on the call. And so I want to thank all of you for following our blog, following our Twitter account. I'm humbled that we got over 20,000 followers there, and a lot of it started with the StockTwits community. We've got over 80,000 followers there. And for any of you that happen to be on the call that voted for us last year for Chart Artist of the Year, I'm very humbled and thankful that you did. Also, I want to share that a lot of original content. I'm also a featured contributor on See It Market. You can see, if you're not familiar with it, you can find them at seeitmarket.com. A lot of articles are written just for them, and then they come back and get posted on our blog. So you can see us in several different ways. We're trying to make different venues to see, share ideas how it can be of help to you. But also want to share that our membership gets to see probably 90% more than what you see on the social media. I respect that they pay good hard-earned money to get ideas. So most of our taking action ideas are to our membership. I hope you can respect that. So as we get started, I just want to remind everybody that I'm not a bull or a bear. I have a business background and a psychology minor, and I really believe being bullish or bearish is nothing more than a psychological state of mind. I'm not smart enough, folks, to have some grandiose knowledge that I know exactly where this world is going to head. I wasn't blessed with that, but I believe there are many clues that can help us play the world as it's just this ongoing. It's what's so fun, everybody. It's this ongoing play. It just keeps progressing and unfolding, and it just keeps creating opportunities and opportunities. And so I wanted to, part of the reason for today was there's some lineups taking place and some chart patterns. I like looking at things short-term, intermediate, and long. I believe that we really should start out with a 30,000-foot view to see where we are. But I'm going to eat some of my words today, and we're going to start a little bit shorter. So let's just get into the meat of things, as Rick says. And Rick, thank you for being part of this. None of the Kimble charting solutions would be possible without you, Rick, and I thank you. So I wanted to just kind of share, I'm here because of things that Sir John Templeton shared with me and many other people, but he was one of the greatest influences, and he gave to me. And he gave some timely information to me that totally changed my financial planning practice. I can't promise I can do that for each of you on the call, but I'm going to try to share some stuff that I hope at the end of this call, you're different. I hope that you're more powerful. I hope that you're informed. I hope that you can see efficient ways to make things happen. So that's my way that I want to try to help. So one of the ways is how can you build short-term and intermediate channels, and how to spot entry and exit points. Well, to me, a chart is nothing more than, what is it, everybody? It's all of the known knowledge to every man and woman on the planet, and it's kind of like an EKG, except for it's expressing emotions. And so how can you make profitable ideas out of these people's emotions? And so I tend to start with, in a rising trend, I want to look at times that's up, they're upset. In other words, lows. And can we start tying a bunch of lows together? And then what I try to do is, how could you use those lows to your advantage to see if there's actually a trend that the world is making with their emotions? So this is an example of a NASDAQ 100 over the last 8 years on a weekly basis, to where we started out with the lows. And we're trying to see if the lows could become helpful in maybe exit points, or maybe not an exit point, but a place where you could what? Bring up stops, or where you could watch reversals to see if maybe the trend could be changing. So it shouldn't be a surprise when you see this trend to see some of the action maybe that took place a couple of weeks ago, that we had that sharp decline. But now I want to show you within that channel how we use the opposite, how we used the happy times for a buying opportunity that we did on Friday, February the 9th, that we're going to discuss in the next slides. So I want to give a shout out at this point in time. The software where the chart that you're seeing is from Metastock. You can get it from equus.com. But one of the things that Rick and I made a big change last year as far as just some opportunistic tools, and the big shout out would be to TradingView. TradingView has some really cool alert systems in it that have really helped me help our members. And it's in the form of alerts like I haven't been able to experience in a few decades of doing this. And so what is fun is, we're sitting back and I'm using my decades worth of experience in charting to set up these systems to then send us alerts for breakouts and breakdowns, reversals, and of the like. So just wanted to share that this is a good way. I want to give away some of my experience to say this is how you can find reversals and buy points. So we took this even in a little bit more of a micro way a couple of weeks ago. How do you find potential support and buy points? Well, you find them first by looking at highs to try to find lows. So this is Apple on the left, Google on the right, weekly charts. And then we want to see is there any downtimes that happen to correspond with the highs? So you can see that both of them in about a 15-month time period had made fairly consistent higher highs. Then what you want to do is find a system that can do parallel channeling for you, which is out there. And what that did was, with the help of our experience, our insight, and the trading alerts within TradingView, I got alerts on that Friday morning, February the 9th, that we're seeing some reversals that had hit the channels that we had pre-programmed in ahead of time. So our members bought both of these on February the 9th. And so, year to date, I was, and just keep in mind, I did these numbers earlier in the day, and I thought, well, maybe I should redo them later because the market was up 300. And then now I'm thinking maybe I should have redone them a little bit because the market ended up down 160. But just to be fair, these were done, I believe, at either 10 or 11 o'clock Eastern time this morning. But this is a year-to-date numbers on Google, the S&P, and Apple. Not anything real impressive, but Google did lead the pack. But from the prior chart, we showed how you could use highs or emotional euphoria to find lows for buying points and look for turning points. So if a person was fortunate and we did not hit the exact lows on that, because it was a really quick turnaround. If you remember that Friday, forgive me, but I think the Dow was down 400 or 500 points and then did a reversal, closed up maybe around 4 or something like that. But this is, if you were really perfect on that day, these are the gains that you could have had in Apple, Google, and the S&P on those reversals. We were fortunate, blessed, as of 10 a.m. Eastern, 9 Central our time, our positions with the membership was up 1179 in Apple and 10.5 in Google. And I think both of them finished the day up just a little bit more. But these are examples of how we're trying to help people on using intermediate terms to help find even shorter term moves when you see some really emotional swings taking place. A couple other things that helped us that day was, this is from sentimenttrader.com. I can't say enough great things about them and their research. Their website down at the bottom is sentimenttrader.com. I've been a member for years and years and years. But one of the great things that they do is they look at the number of optimistic indicators divided by pessimistic indicators. And one of the things that intrigued us a couple of weeks ago is you can see that optimism was really quite high as the NASDAQ was hitting the top of that channel a couple of weeks ago. But then you saw this big decline. And so this is an updated chart that you can see the cockiness or the euphoria has really churned quite dramatically over the last few weeks. And you can see actually that a few of the bottoms over the last, 3 years occurred when these indicators were close to this low. But this was one of the tools that helped us see, wow, we all know of the VIX exploding to the upside and the XIV imploding to the downside that same week. Those were some of the tools that gave us some confidence to take some of these short to intermediate term trades. Another thing that really helps us a lot, and this is from stockcharts.com, is we really believe, as Ross Perot used to say, you should lift up the hood and look underneath. To me, this is one of the greatest tools that from a starting point, you should almost look at to see, are there more advancing than declining issues? You know, in bull markets, the majority of stocks go up. In bear markets, I think for most of my career, I think 90% of the stocks went down. And so I'm not either brave or bright enough to try to think that I can find those 10% that go up when 90 are going down. So the thing that strikes me the most is a positive message is taking place in the Nasdaq's advanced decline. You can see, and I did the same process. We're taking the emotional lows of 2009 and 12. Let's do a parallel channel. Let's tie it to another euphoric point, and you can see that here's a well-defined rising channel. But you can also see another channel that's taking place inside of that that's even steeper. And so one of the things to take note that we've been trying to share with our members for several months is that this trend is positive. It's sending a bullish message. It's still sending a bullish message. But one of the things that has our attention is this is a place that you wouldn't want to see selling get started from a bullish perspective. This is the place where weakness or emotional changes could happen. So this red support line would be a short-term caution message to the bullish case if that breaks at 2. This may look the same, but this is the NYSE. Same thing from stock charts. This is from of common stocks only. So this is taking out any bond funds and closed-end funds. Just looking at stocks, you see a similar picture. Definitely a clean rising trend. But as we've tried to point out now for several months, it was approaching the top of this 9-year rising channel. And the thing I want you to take a note of, whether it's on paper or mentally, is this was created by first starting with these emotional lows. And then you can see that we hit the top of this. And I want you to remember for a minute, 2014. Hey, the first time that this thing hit the top of this channel after the lows in 2012 was 2014. And then what did it do, everyone? It went sideways for almost a couple years. Tested the bottom of this, actually a little throw under. So there's 2 things I want you to make note. Trend is up. 3 things. Rising support test is in play that the bulls will get cautionary message if it breaks. And once it hit this, or the last time it hit it, it actually traded sideways for a while. So let's just stop for a second, and I just feel I want to give something away. So everybody open up your chat boxes, and so you hit the little orange arrow in the upper right. And so for the first one that can answer the following question that's going to pop up, you're going to get a free 1-year subscription to our Metals, Global Trends, or Sectors and Sentiment report, whatever your choosing is. And the annual rate on that is $637. So I'm going to expose the question, and I want you to now pick or choose what the answer is. So the question is, how many years has Chris been involved in the financial services business? Hint, it's a popular Fibonacci retracement number. Again, put your number in the chat. First one to get that correct. Rick will get back with you, and you will get a free choice of the Global Trends, Metals, or the Sectors and Commodity Sentiment Extremes report. And just to let you know, this February, this month, this past week, is my 38th year in the business. So anybody that happened to get 38 would be correct. So thanks for participating and having some fun with that. So just a minute ago, we showed this chart of the lower right, which is the advanced decline line. I said, remember in 2014, it hit the top of this rising channel and then drifted sideways for almost a year. Well, the reason this is important and why I want to bring it up is the chart in the upper left, which is the Dow Jones monthly. And we applied Fibonacci to, and let's just think of emotions. If I was to say, what would your gut tell you was the most emotional price point in the last 12 years as far as euphoria, and the most pessimistic or emotional, frustrating price point in the last 12 years? My answer would have been 2007 as the highs and 2009 as the lows. So we pegged those highs and lows, applied the Fibonacci levels to the closing monthly highs and lows of '07 and '09, and then applied the Fibonacci extension level of 161. In other words, a 61% increase of that high and the low. And you'll notice that once the Dow reached that, what did it do, everyone? It really struggled with that 800-pound gorilla. It struggled, and the market didn't fall apart, but I mean, it had been on a joyride from what, 2011 lows. Look at this, the Dow, what, 12,000 and running up to 17 or 18,000, a huge percentage increase. And then what's it do? Two things at the same time took place. Hits the top of the AD line in the lower right, hits the 161 level, and then what happens? It just trades sideways in a range of, 10 to 15%. So the reason I bring that up is, guess what's taking place right now? So now is a current chart of the Dow where we applied Fibonacci to the 2007 high, the daily high and the daily low. And you can see that the 261 extension level comes into play at 26,701. And we all know that this stuff isn't just completely precise, but in time, if this market really struggles up here, I'd give a high five to old Uncle Fibonacci. Not me, but just from the unbelievable calculation of how this stuff can work, that the Dow got within 0.4%, almost kissed the underneath side of that, and that's when the reversal started. So now do we have a new range getting started? Because where's the advanced decline line, everybody? It's doing well. But it's at the top of that 9-year channel, and here we've got the Dow at the top of at the 261 level. So all strategies. We're not the holy grail. I'm not perfect, as my wife reminds me. We're all like an egg. We're cracked in one way or another, and I'll say that to anyone. But one of the interesting things is every good strategy has its weak points. And so what is the weak points of a momentum strategy? What's the weak points of a moving average strategy? Well, one of the challenge points would have been this 20-month sideways taking place here. So if you're implementing relative strength and moving average strategies, what this starts doing in here is going to be really important to what you do, because this choppiness, even though the market's not going anywhere, for all of you that are familiar with those very good strategies, you can all of a sudden be buying at the high, and then next thing you know, you're getting out at the low, and then it goes back up, and you're buying at the high, and you're getting out of the low, and it's just turning you into hamburger. So I want to empower you that this could be an interesting price zone that, right now we got resistance around 26.7, and so far the support would be in the Dow around 23.3 in this band. So you see what a 3,000 point range. That's a little bit over 10%. So it'll be interesting because, the takeaway here is the advanced declines line at the top. It hit this and reversed. Could be really intriguing where this goes from here. So I want to now take it a little step further and look at how to build long-term channels to help spot entry and exit points, or maybe places where you want to bring up your stops. If you're a buy and holder, well, maybe something's done really well. Maybe this is where we take some pocket change. But we're going to stay consistent in how we do these things. And so whether we showed you started off with the NASDAQ on the 9-year chart, or we went to the 15-month chart on Apple and Google, we found advantages there. We're going to find those same techniques can work in a 70-year Dow chart. Actually, it's longer than that. This chart goes back to 1905. So it's 113 years in length we're looking at in the Dow on a monthly basis. But again, let's take the same principle. For some reason, there were several lows that took place in the 40s, in the mid 70s, in the early 80s, and could those have anything to do with these highs? So let's start out with, and let's try to find commonalities of, can we consistently see an emotional trend taking place? And you can see that we did, here, starting with some lows in the 40s, more lows. And again, this is a monthly chart. So anytime it hits this on a monthly basis, it probably spent a little bit of time there, unless there's a reversal pattern. So you got it in the 40s. Many of you on the call probably weren't born then, but I didn't understand what Watergate meant much. I didn't understand what Nixon getting impeached much was, as I was a junior in high school. But look how that time period, the 50% drop in the Dow, took it right back down to that line. And then you can see that it tested it a couple of more times. And then I got my securities license right in here. And lo and behold, I first met my mentor and Sir John Templeton on Wall Street Week. The Dow is at 800. Mind that even though it's at 800 in 1982, it was at 1,000 in the mid 60s. So as I got my securities license and I went to people, yeah, stocks are a good thing. Man, they couldn't wait for me to that door to hit my backside on the way out. Hey, Chris, interest rates are 12 and 15%, and gold's at 850 an ounce. Why would you want to buy stocks? Well, in hindsight, why wouldn't you want to buy stocks on nothing more than a 40-year support line? Sir John's on there and it's down below 1,000. He said, we'll never see it again. And boy, was the old guy right. But now let's look and see can we take that parallel line and use it to our advantage today? I mean, I'll be the first to admit is why should something that took place 70 years ago, Chris, be important today? I don't know that I'll ever live long enough. If I lived another 100 years, I don't know exactly why, but I don't spend any time on why. I gave up on that long time ago. But I do know that if you knew this chart, you might have taken some action in 2000, right up here at the top of that channel. And when momentum was off the Richter scale, you might have taken some profits. You might have really paid attention to support lines. You might have watched extra hard on crossovers of moving averages. All of those things come into play again. And then what do you see here as the Dow's kissing that 261 last month? What's it also kissing? The top of the 70-year channel with momentum rather high. So here's just the same chart again, non-animated, ones that I've shared on the blog recently. This is the same chart, but also look that if you just do another copy paste parallel line, look how the highs in the 50s and 60s, and lo and behold, that's where 87 crash took place, kissing the underside. Sorry I put the logo here, but this was what Saddam Hussein, when things were pessimistic in 1994, that once it broke above this and used that mid-channel line as old resistance, as new support, it blasted off to the upside. So the thing that gets my attention here is two things, everybody. It is at the top of the 70-year channel. The bull trend is still up. Nothing's changed that the last couple of weeks. But I think you should be empowered to know that it's at the top of that channel and also to recognize where monthly momentum is. It takes a while for momentum to get up to certain levels, and it doesn't turn just instantly either. But the thing that jumped out to me is the monthly momentum is at the same level as 2007. Excuse me, it's a little higher. It's as high, same level as 2000. It's the same level as 1987, and it's the same level as 1929. This doesn't mean a top has to occur, but to me it does say that, man, this puppy's rather extended. And as we're all, many of us probably watching the Olympics, and boy, those Nordic track skiers, you ever notice when they finally cross the line, how many of them are just, I'd give anything to be a quarter of the shape of those people, but when they cross the line, what happens? A lot of them just fall over in exhaustion. They just got to catch their breath for a while. So these top of channels can really be catch your breath moments. So one of the things that Sir John said before he passed away, he said, I think the world is one of the riskiest stock markets, or one of the riskiest things I've ever seen. And a lot of people understood Sir John as being a fundamentalist, but that was the last thing he was talking about. It was all about correlation. So this is what a 9-pack that we often share with our members. You can see they're labeled in the top row, the S&P, the Dow, the NASDAQ, Russell Midcaps value line, and we go overseas to look at Germany, France, and London. The thing is, they all do look about the same. So I use some of the same procedures. I look for lows to find highs, and all of them are kissing. They're all in bull trends. Nothing at price point 1 has changed that. But the bulls want to see these things break out. What the bulls don't want to see is weakness start at each one of these. And just because we've seen weakness for a couple of weeks, and just because we saw the sharpest 10% decline in eons since before I was born, doesn't mean that the top has happened, but that sure is an interesting price point, folks, for that stuff to start taking place. So you don't have to go stand on your head or turn your notebook upside down. I turned all those same charts upside down for you. So I want to stop and thank everybody for sending in a lot of questions. We got hundreds of questions about different assets, but a lot of them, of course, fall under certain categories. And there was good questions. I'm 70 years old and I'm buy and hold. What should I do? Or I've got new money. How should I implement or whatever? Right now, folks, the trend hasn't changed. but I think it's good. I do this on purpose to myself. I invert these things, and then the red lines are falling supports. And to me, the rubber doesn't meet the road until those are broken to the upside. So this is a way to look at what would inverse ETFs look like in these major indices. And the bulls are going to get a caution message after it's hitting support if they happen to break above resistance. So this is another way that I hope to empower you to just, folks, look at things a little bit differently. It's all opportunities, but here we are looking at really long-term falling channels and falling resistance lines that have broken to the upside. For aggressive traders, I wouldn't do any shorting until we see those break. After that, we'll see how things are taken, how they're starting to unfold, because you could have a different game plan in mind. Another thing I want to empower you on that I'm finding a little bit of intrigue with, we all know that interest rates have just rallied really sharply. This is the S&P 500 divided by the 10-year yield and forming a ratio. So the SPX/TNX. So you'll notice that the financial crisis low down here in the lower left, how low the index was, and then it shot up. In other words, that what? Stocks are outpowering the rise in rates. But you'll notice the last couple of years, mostly sideways motion, potential classic head and shoulders topping pattern. So if I was a long-term bull looking for potential harvest points, looking for measures to maybe take some gains off the table after some things have gone well, I wouldn't forget about what this is doing. Because if this ratio would decline, it would definitely show a 3-year trend break. And again, this is the combination of stocks and bonds, the yield ratios versus a stock bond ratio. Still similar, but this is an interesting pattern that could be a topping, very intriguing to me. I was fortunate in the late 90s. Keep in mind that we didn't know much. I guess in some ways we did know better. Buy and hold was really a cuss word, folks. Passive investing, buy and hold, it really stunk it up here because nobody wanted to do it in the 80s because it hadn't gone anywhere for almost 20 years. I was fortunate to get involved, and you know, one of the lucky things that I just came across, I mean, anybody could have, I wasn't smart by doing it, is right here while this market was flat, Sir John somehow averaged 15% a year for 15 years while the market was flat. That got my attention. I was reading about him in Barron's magazine, wondered how this guy was doing so great on the long term. Started learning about him, putting some money, and so it became much easier to be buy and hold oriented. And you know, this blast off in the 80s, and so I want to bring up a couple of things. You know, the late 90s are coming along, and I get some information that Sir John has decided to short on his own every .com stock. So instead of just trying to pick and choose, he just said, I'll just do everyone, and we'll just see how it works out. And then I feel like I need to buy zero coupon bonds of the highest quality governments in the world. Well, if you read between the lines, let's see, it probably thinks the high flyers are going to fall. And if you think zero coupon bonds that are not paying any interest are going to go up, you think interest rates are going to fall and bonds are going to rise. So one of the questions at that time, when I find out this, he also shared a book with me. And my question is, does anybody know, we're not having a quiz on this point, I probably should have, but what book did he suggest me to read? And this was the book, The Extraordinary Popular Delusions and the Madness of Crowds. And if you want to open your chat box, I'll do this. So the first 3 people that say, I just type in your name, I want this book, I'll get it to you. Put your name and address, first 3 to do that if you want this book. I continue to share this, folks, with everyone because, you know, Sir John was a very religious man, but it really caught my attention when he said, Chris, outside the Bible, you know, this is one of the first billionaires in America, one of the best money managers ever, when he said, Chris, this is the best book I ever read outside the Bible. That got my attention. And I am so blessed, darn it, and thankful that he shared this book with me, folks, because it'll have you looking at things differently. It's really been beneficial to me, and I want to pass along what he did to me with you. So the book was about popular delusions. And we're going to talk about passive versus active for a minute, but maybe not in the way that you think. So most of you on the call probably are already active-minded. You know, so this isn't, I'm not trying to get anybody to change from passive to active. I want to look at the crowd. So we have a chart that we've looked at, a long-term chart of the S&P. And in the right, we have inflows to this turquoise is to passive funds, and the gray is to active funds. Passive, active. So what do you notice in 2008? Where was money going? It was going to passive. Hey, market's going up. Let's buy and hold. Yada, yada. Things are good. And let's get out of that active stuff. Yeah, you don't need to do anything but just hang with this market. Well, that was taking place right here at number 1, which happened to be at the top of this channel based upon, remember, taking angry times, copy pasting, and seeing about parallels. What this happened to be taking place is going way back, when it's 2000. You see momentum was very high. Then you can see at 2, when you had a 50% decline in the S&P, well, guess what? People started questioning passiveness. And you can still see they even pulled some money out of active. So that was probably a good sign for the market overall to be a bottom. Well, then the market goes up for several years, and then what do you see? Excuse me, it comes after the 2009 low. The bottom line and takeaway from this is society was piling in to buy and hold and passive at 1, and they were bailing out of it as it was near support or at 2. And so look what they're doing now. Passive has become the thing. Why not after 9 years up? 9 green years in a row. It's probably going to be 10 and 11 and 12. And it doesn't mean that it can't be. But while it's testing this, and you see society piling into passive and bailing out of active, from a Popular Delusions book, I find this very intriguing. So how do we build combo channels? And talking about intriguing, this is one that if you're going to really make some notes on, it could be this combination. So we're going to start off with the second part of the combination is 10-year yields. So we can still do the same process. Let's find unhappy times. Let's find happy times. So here's a 25-year falling support line. Let's do a copy parallel paste of that. And look where we have yields right now, testing the top of this resistance line. And lo and behold, when were the other 2 times it was closest to this line? 2007 and 2000. We see momentum's fairly high. And let's now find some the lows. Let's copy parallel that and some highs. So we have really a multi-decade test to the trend that anybody that is of a certain age, this is pretty much all that we've seen for a long time is falling rates. My first mortgage in the early 80s was 12.5%. It just seems like they're giving away money right now on mortgages. It's just unbelievable how much things have changed. It's hard to ever believe that took place. A huge test. But now I want to talk combos. So we've been showing this 100-year chart on the Dow, which is on the top, and we just introduced the falling rate chart of the last 20 years at the bottom. And so let's see if there's any commonality of unhappy times, and let's see if there's any commonalities of happy times. So again, both times these are the lines that we drew earlier in the webinar, then the last slide in the lower right, and now we're going to do copy parallel paste, and you can see a dual test of the Dow in the upper right and yields in the lower right at the same time. So here's a chart that I want you to just see. As I used to get in trouble with my parents, always asking what if. Since you're not here, in my office, I'll just ask you what if. What if this is meaningful? What if it happens to be? So we just went through these 2 charts. So you'll notice that when the yields were hitting the top of this in 1999 and 2000, the Dow was also hitting the top of that channel. Then you'll notice when yields hit the bottom in 2003, the Dow and S&P also hit a low. And then the next time it went to the top of this falling channel was in 2007. At the same time, it was at the top of this channel. And then in 2009, it's back at the bottom, and then back at a low and an opportunity. And so to me, folks, this is why one of the things that we led into this is multi-decade situations, folks, going on. 10 decades on the top, 7 decades on the top, and 3 on the bottom. So from a bullish scenario, bulls what kind of triggers would get your attention? If you saw some selling at the top, or if you saw yields breaking down. Now, could yields break out and stocks break out? They absolutely could. But so far, for what, a couple of decades, it's paid to really have tight stops on the top chart and be open-minded to bottoms or bonds bottoming on the bottom. You know, the cool thing, folks, if these are really going to go, as I love to say, if the train's going from A to Z, if big changes are going to happen, we don't have to be on board at A. We just want to know where that train is going, because we probably want to get on board station B or C. So we don't have to take positions ahead of time. You could speculate in small pieces. There's nothing wrong with that. But I want to empower you to what these big trends could be, because this could be a doozy. Another one I think to watch is semiconductors, which has been a huge leader of the pack. Semiconductors have outperformed the S&P and the Dow since the 2009 lows. So this intrigues me, is that this blue line across the top, this was the 2000 highs. It's after the huge debacle from what, 100, I mean almost a 80% decline plus. It's been in this quality rising channel. It's now at the top of the channel and also 2000 highs. I think we're going to learn a lot, folks, in a positive way on a breakout. In the bullish case, would not want to see a breakdown at 2. This is a monthly chart. You can see that tried it this past month and then has rallied back. So this is really a rock and a hard spot. That's an opportunity to really monitor and watch this, everybody. I'd encourage you to keep this on your radar to see, does this thing break out, or does selling start at the top of this channel? It's going to provide, I think, really quality messages. I want to give away a couple of indicators, not products, but just empowerment that I've not done before. One of the things that I like watching in the background is, you know, real estate's a major part of our life. Building and growing is a major part of our economy. And I would behoove you to, every once in a while, you can go on bar charts, or maybe your software has it, and watch lumber to see what lumber happens to do. And so lumber, I'm going to go backwards just for a second. You can see since, '09, been in a really quality rising channel. Really got elevated from 2015, has taken off. So it's near the top of the 3-year rising channel and the top of the 10-year rising channel. And so just to kind of show you a couple of things, it's not some perfect indicator, but you know, when lumber started turning down here in 06 and 07, it was really kind of ahead of the pack. You can see that it started turning down up here a little ahead of the S&P. Then you'll notice that it happened to create a double bottom before the S&P did. Then it started taking off. You'll notice that it saw some lower highs, and that preceded maybe some flat markets to not going anywhere. And again, folks, that's when the market hit the Fibonacci 161 that we covered earlier. That's when the advanced decline line hit the top of that channel. You'll notice lumber came back down to this rising support, and you'll notice that it happened to actually bottom and create higher lows ahead of the market. So nothing negative coming out of lumber at this time, but it is really close to a couple of resistance points that I don't think stock bulls would really want to see it turning over there. And one of the things that catches my mind, another great piece of info from Sediment Trader, is that the 2009 lows, nobody wanted lumber. You couldn't find hardly a bull on the street. And that was a great time to buy lumber. And now you can see that lumber bulls stand at 90%, the highest number in 10 years. So this would be a price point that the bulls and stocks might not want to see any selling in lumber take place. Another thing that's a proprietary tool that we share every week in our global trends reports, our shoebox indicator. What the heck's a shoebox indicator mean? I just came up with a name, whether it was right or wrong, just kind of thinking about, could this indicator, the idea behind it, folks, is, you know, when you don't like things, maybe you know, historically people want to stick their money under a mattress. I want to hide it. But when things are decent, you want to take the shoebox out from underneath the bed and invest it. So this is a tool that has to do with certain types of debt instruments. It's a cousin to junk, but it's not junk. I like it because it reacts differently to junk. It's very sensitive. It often can give, the trend is up. It can give some good buying signals when you see it wash out above this rising multi-year blue support line, as we've shared each week for several years. It continues to send a bullish signal. But I want to make note that, you know, it started flattening out, and then all of a sudden it started dropping, And so it sent us a signal. You can see the S&P at the bottom before the decline came, that there's some couple things stink in the market underneath, to where you got a couple of choices. The first one that we did was we're going to pull up stops, and the second one would be you could harvest some gains. So the shoebox indicator is testing some support here that the bullish case would not want to see break that. And again, this is we share this every week with our premium and our global trend customers. Turning to interest rates, we all know that interest rates have risen a lot lately. We also most often hear that the death of the bond bull market has taken place. I think it's on a last leg. It doesn't matter how you define it's dead, but right now, using the tools that we looked at earlier to where we're to try to find tops by looking at bottoms. This is the 10-year yield on the left, the 30-year yield on the right. Tried to stay consistent. I took the bottoms, copied, paralleled the highs. There's 1999, 2000, 2007. You can see that the yield on the 10-year and you see the yield on the 30-year are both hitting the top of this channel. That so far for 25 years, this is where rates have peaked. So game plan is you would want to be a buyer of bonds. I don't see a lot of good price action bonds right now, but this is what has paid off. You can see momentum is overbought. And then if they break out, folks, this would be a break of a 3-year trend and a 25. If they both broke out at 1. Your plays would be to reduce exposure in bonds. If you want to inverse bonds, the 1x inverse is TBF, the 2x is TBT. I'm going to let it prove itself before I would do that, but I want to empower you that I don't think the decline is over. I believe rates have got to go up sometime, and I think it's a big deal, folks, if they break out of here. But it would also be a big deal if stocks started turning weak and bonds started acting stronger at this price point. And one of the things that's really rare, this is at the top, this is the same yield on the 10-year note, and this is a performance over an 84-week. Talking about rates rising, they're up 110% in the last 84 weeks. That's the sharpest rally in 20 years. And that sharp rally has taken us right to the top of the falling channel. And the last time rates were this high took us also to the same height, were the highs of 2014. So from a performance, relative strength, and trend line, power of the pattern perspective, really a fun test that's going on. We get a break out here. I think the government's got their hands full with 20 trillion in debt and rising rates, but we'll see if it can break out from there. Big test. This is TLT, the common long play in the government bond market. Looks like a head and shoulders top to me. Whether it is a head and shoulders top, this has been a key emotional line of happiness, frustration, support, and that's taking place again. So obviously, if yields would break out, TLT would break down, I'm interested in owning TBF. Right now is a big support test in my mind. Another canary in a coal mine indicator I wanted to share with you that is not some huge secret by any stretch, but I just wanted to remind you of different ways to look at tools to tell you, is this a real deal on an interest rate breakout? So this is a combo chart that the top one is copper futures divided by gold. And why is that important? Is typically when this falls, interest rates are put under less pressure, and when it rallies, they're put under more pressure. And then you can see at the bottom a mislabel. I apologize on my part. This is the 10-year yield, everyone. So you can see they look a lot alike. And you can see they both peak together here. You can see a bottoming process here, a peaking here, major trend down, a rally. So here's what interests me is, now here's the same chart that we just looked at with a little bit of technical analysis applied. You can see that the trend is actually still down in the ratio. It hit it a few weeks back. Who knows if that's a topping pattern? Still in this rising trend. Let's see if we can find a trend in yields as well. So we see a resistance test in the copper gold ratio, and also a resistance test in yields in a long-term falling environment. So this could tell us what these two do, folks, to help you a lot in your bond plays. So it's time, open up your chat box. Got another question. And the winner of this one will also get another chance at a 1-year annual subscription for free to our Metals, Global Trends, or Sectors report. And that question is, how old will Chris be this year? Yep, it's a Fibonacci retracement number. And it's hard to believe, you see I even choke on the number, but this year I'll be 61. So we've went through a couple of numbers that this is my 38th year in the business. I'll be 61. I don't feel my age. I love what I'm doing, folks. I love working with you, having fun with you, trying to empower and enlighten you, help your families. We've had a great this past year. The Power of the Pattern's treated us nice, which means it's treated the customers nice. We've got some really fun emails from our customers, and I can't help but just say thanks to all of you for being on this call. So one of the things was we ask everybody questions. What would you like to hear about? One of the big things was commodities, and so let's just dig into those. Let's apply some of the same principles earlier. So this is a Thomson Reuters equal weight commodity index going back over the last 50 years. So you can see that what I did was I wanted to start with this rising pattern, start with highs to try to find lows. And so you can see that they peaked in 2011, and this is a monthly chart. You can see it hit support, which is a real positive for commodities. You've seen that they've made a series of higher lows over the last 3 years and flat tops. So there's a chance that for anybody in a pattern analysis, what could that be? Could that be an ascending triangle in a longer term trend? Usually you want to see ascending triangles while the whole market is in an uptrend. That's what we've played this past year successfully, but there's a possibility. So let's look at this two ways. Let's also try to find, as we try to find bottoms by looking at these tops, I want to try to find a top by looking at these bottoms. So you can see a real battle's going on with no wiggle room. That's going to help us in a serious breakout or breakdowns. So you can see that commodities are testing a 20-some year rising channel on support while it's went from the top to the bottom and testing the bottom, or the, resistance of the 7-year falling channel. So it's going to tell a lot probably about interest rates. Historically, folks, what would happen if commodities broke to the upside? Tend to be a little pressure on interest rates. And if it would break down, maybe a sign that interest rates have peaked. So there's another long-term train that could be leaving the station that let's let the world decide where it's going. From a monthly momentum basis, you can see it got greatly oversold. A little positive potential momentum element here is rising lows. So a breakout here would be a positive. Several different ways to play that complex. You could play from a ETF world if you're not into the futures, and there's nothing wrong with those. But if you're in an ETF world, DBC would be a consideration. DBA, which is more slanted towards agriculture. People could, you could go a third. You could have some oil. You could have some metals. You could have some grains. There could be a lot of ways. I would really love to see commodities do well, just from a bias of wishing maybe the world grew. I would like to see a little bit of growth. There's been a lot of deflation, obviously, that's going on in this space. Maybe it would be okay to have a little bit of inflation for a while, see how we handle that. That's a different game than deflation. So some really intriguing breakout or breakdown is going to take place. We'll see which way that train, leaves. So we shared this chart just kind of to let you know. So not only are these tops fairly flat, we got a lot of resistance here. We got a falling channel resistance, level highs. It also happens to be the first fib level, the 23% retracement of that huge decline off the 2011 highs, and the 2016 lows. So big train to potentially follow here, folks, on a breakout or breakdown. I'm not much of a cycle person, folks, but I don't think we should totally stick our head in the sand. But it does kind of intrigue me a possibility. This is the same chart that we've been looking at, the Thomson Reuters Equal Weight Commodity Index. I was just kind of playing around with time frames. I would like to just see if this is, obviously, are there repeating trends, but are there repeating time frames? And what it on the surface appears potentially that about every 16 years, commodities tend to bottom and hit a high about halfway through it and then hit a low. It's not about the preciseness of the timing. That's where the power of the pattern comes in. But it is intriguing that from this cycle research that, you know, a low took place here, a low took place here, not that it was a huge rally followed, but another significant low took place here, and another one is potentially due here, right when the commodity CRB index is on a 30-year rising support line. A little bit of information I just wanted to share, you know, along with you. Another possibility to play that we didn't mention a minute ago would be we've seen steel doing fairly well off the 2016 lows. This is SLX. It is testing the 2013, 14, and 14 and a half, 15 highs at that number 2 up there with rising bottoms. So if the CRB index would break out to the upside, and I would want to follow, if you didn't happen to own SLX, an upside breakout if that would take place. Turning to metals, I think one of the best indicators that all of you could do with most software, nothing fancy, is just take silver and divide it by gold and look and create your own silver gold ratio. This is something that's been important for me for years. To really back the truck up, folks, in gold and silver, either or, just but from a positive metals perspective, you really want to see this puppy heading up. And you can see that for the most part, it's been in a 30-year channel, fairly well uniform from taking the highs, copy paste to the lows. So you can see that it's now testing the bottom of a 30-year channel. It's also testing roughly the 96, 2003 or 4 lows, 2008 or 9 lows, 2016 lows, and here. So if you're a metals bulls, you say, well, there's some real opportunity on support, and there really is, from just a frustrating, really going for the most part nowhere for a lot of years. But the thing you want to be cognizant of, it still remains in this falling channel, and it would be a really negative news if it would break that support. So to me, this creates a value opportunity. I think you should be aware of it. This is where a reversal could happen. If the prior charts, we see the CRB breaking out to the upside, and if we see this silver gold ratio taking off, I'd want to back the truck up. Right now, I'm just going to, this train is not going in the right direction. So support has to hold and a breakout has to take place. But this is from an extreme position, folks, that has been an opportunity 1, 2, 3, 4 different times in what the last 20 years. Big fifth time tests going on, and the metals bulls do not want to see this puppy give way. So if you're metals bulls, pay attention. Bears look away for a time frame, just for a minute or two. But this is silver going back into the 70s. Cup and handle patterns are often characterized by level highs. So in the early 80s, we had $50. In 2011, we had $50. What if this was a major basing pattern and this is the handle? So we would want to fasten our seat belts if you're a metals bull. If we saw a breakout at 1, that'd be a real positive that this could be the mother of all cup and handles. Not proven, but we'll have to see. We shared this a couple of years ago when it was right here. And this was a key Fibonacci ratio that I didn't apply. I just wanted the chart to be clean. But key is, it's up against falling resistance. So if you're a bull in metals, I want you to look away for one slide, and I'll tell you when to look back. So this is the same slide in silver on a monthly basis, to where you had the double top in 2011 with potentially a multi-year topping pattern and the rising neckline with a descending triangle taking place here. So this is as the silver and gold ratio is testing 30-year support. This potentially is testing a neckline. So again, another multi-decade pattern is at hand, folks, that will lead to opportunities regardless. If you just put your bias in the trash and just be open-minded, that cup and handle or this topping is going to be correct, and that train's probably going to leave, and it's probably going to have an extended move. And so again, at the end of this call, I want to empower you to possibilities. I want you to see what our members are seeing, and I'm just really excited about the opportunities. And why I think a big opportunity is at hand is it's another huge test in the currency markets. We got the dollar on the top, euro on the bottom. Euro is at the top of a 10-year falling channel. There's a potential bearish rising wedge taking place, and the dollar's testing a cluster support after a 14-month decline and a potential bullish falling wedge. So what the dollar and the euro do at 1 and 2, sentiment has come up a little, but the sentiment on the dollar was in the low 20s and the euro was in the 80s. So we saw a crowded trade taking place on both sides. So what takes place here, again, this is not multi-decade, but it's close to 2 decades. We have a really huge inflection point taking here, which is going to lead to a lot of fun, because folks, I'm not really that excited about trading the currencies. They're the dog that wags the tail. So I really believe you should pay attention to the dog here, because then the tail has the standard deviation as it sloshes back and forth. Think of a happy dog from one way or another. That's where your standard deviation is. So if we get a breakout or a breakdown here, it'll lead to opportunities in commodities in either direction. Big test the bulls want to see here. We got gold on the right. We have the XAU index, which is the gold and silver miners index. It's the longest existing miners index on the planet. You can see they both have potential bullish cupping patterns. They're up against resistance at the same time. Very little wiggle room on each. So I really believe here, again, long-term trains are going to leave the station one way or another. Let's just sit back, be patient, and let's just see where the world takes it, and then let's hop on board those trains. One of the possibilities, I got several questions on the grains, and so you can see this is JJG. You can see that it's continuing to be in a downtrend, a potential bullish falling wedge. There's 2 overhead resistance levels here. Have no exposure in this, but I will say that if we would see dollar weakness, euro strength, CRB breakout, and a grain breakout above 4-year falling resistance, I'm definitely interested in the grains. A lot of people ask about crude oil, so I want you to see some of the same principles. Here's crude oil on a weekly basis going back 3 decades, 30 years, a high, attempted breakout, and then once it finally succeeded here in the early 2000s, it blasted up from what, $40 to 150. So keep this line in mind. So then I did a copy paste parallel to the highs prior to the collapse and lows, and then I applied it back to these lows, and you can see that the rally in crude oil off of this 30-year, 25-year support line here came up to hit the underneath side of this, and also this series of emotional peaks and lows, and then that's where the crash really got started right here. So we have a dual resistance point test for crude oil in a long-term downtrend, in an intermediate uptrend, that if this train breaks out to the upside, you could see probably the CRB or the Thomson Reuters would break out to the upside. You could see a significant rally to the top of that channel. So again, another train that's up against a really critical long-term level that I think can help all of us in some, forgetting the day trading stuff and even intermediate, short-term day traders, short-term, then looking at intermediate to long. So many of these charts today were designed for the people that are looking for intermediate and long, to where you could take some positions, hang on to them, sip the Bahama Mamas if you want, and just let that train take you to some good destinations. And this is why we wanted to get together and share this all for free, folks, because I haven't seen this type of cluster stuff taking place hardly ever in 38 years. So as we're wrapping up, I just want to say that we all have 3 things in common on this webinar. And what do they happen to be is death, taxes, and all of you are judged, all of us, including myself, we're judged on our entry and exit points. We're not judged on, how we trade tweets by our president, how high PE ratios are, is the margin debt just off the Richter scale, how's the yield curve doing, is the Fed going to raise interest rates, what are all the underfunded pensions going to do, how do we handle the 20 trillion in debt, or what's the leader of North Korea up to? That's not where we're judged upon, folks. It's entry and exit points. And so my goal, in working with our people is we want to be partners. I want to take my experience in living in the charting and financial services jungle for almost 40 years to share my knowledge like Sir John did with me, to give it to you, to help empower you to make better decisions and do it efficiently. And what do I mean by efficiently is, we started off, we've talked about, everybody's seen it as the 30-second advantage. I appreciate and respect that all of you are busy in your lives. I do my best to try to have some fun with these charts, but also give you some ideas on what action to take in 30 seconds or less, where the breakout and where the support points are in respect, to your busyness. Nothing wrong. Go read the 9 or 10 page report of anything that you want. There's not a darn thing wrong with that. But we want to provide something a little bit different and unique to make you efficient and effective, in your life. So for me, this will be the last quiz. At the end of that quiz, we're going to up the stakes a little bit. So we're going to give away to the first person that responds correctly a 1-year subscription to our most popular package, which is our combo package that Rick will talk about in a little bit. It's the combination of our weekly metals report, our weekly sectors and commodities report, and our global trends report. That report is $1,297 a year. And so the question is, have your orange arrow box out, is how many years ago was the top in 1929? And hit, it's a number in the Fibonacci sequence. Did anybody get the number 89? So it sure was. Well, folks, I appreciate so much all of you staying on task with me today, staying on board with my ideas over the years. Made many friends, gotten many ideas that, sometimes we've helped people as much as just keeping them out of trouble as, knowing when to sell something or not buy at a resistance point as much as to sell something. So I'm going to turn it back over to Mr. Bertino. And again, thank you everybody so much for being on the call. Hope you're a little more empowered today than at the start of the call. Humbly, I don't have all the answers by any stretch, but I hope you had some fun, look at life a little bit differently. I pray and I hope you'll give us a try. Rick will share that we got a 30-day guarantee. If you don't like Chris, you don't like my noise, you don't like whatever, there's no questions asked, folks. We're in here to try to help, and that's what we're really attempting to do. So Rick, it's all yours.
Okay, see if I could switch this back to me. All right, great. Well, thanks, Chris, and we've communicated out to the winners of the books and some of the individual weekly products. The last one I have up here, who got 89 correct, was Bill. I think it's DeWall. Bill, it's DHALWAL. So Bill, you've got the last one, the weekly combo for free annual subscription. So great job, and great job, everyone. I mean, we got a ton of answers in seconds, and I had to go back and look, and many of you were correct. And I'm sorry, there's only just a few winners. We can't give everything away, but we got them down, and I'll contact you. For those that did win that I contacted, make sure you email me. I've already communicated with you, but make sure you email me your name and what you won, and if there's a book, the address. If it's the product, I'll get back to you on that, of course, and we'll get that all set up for you. So I am going to cover a couple things real quickly. It's how to stay current on the research. And again, we're still not done giving away here. We've got a special offer to 61 people who, in this case, have an interest in our research. And there's a specific research I'm going to go over, and it's going to cover an extension or give away an extension to that research. So let's talk about staying current with the research. Some of you may be familiar with our products. Many of you probably are not. We offer individual research reports, 3 different types of reports: global trends, sector commodities, and the metals. They're available separately, in other words. Our weekly combo, which is these same individual reports to your left, bundled together at a steep discount. And then the last is all the research we produce, which is our premium research. So if you are not familiar with our research, trying to review all of this, which you certainly can go back on our website and do, a lot to compare and to decide on. So how can we make things a little bit simpler for you in terms of what's the best value? Unless you already know specifically what you're looking for, the question might be, what's the best value for your buck in terms of the research and that package that we could offer to you? And so to answer that question, I think part of it was going back and looking at, well, what do most people subscribe to and why? So let's look at what most people have subscribed to. And in this case, it's our three weekly reports. There's a couple reasons for that, because in our weekly combo package, it's our global trends, our sector commodity, and the metals, all 3 of our individual products wrapped up in one. And when you buy 2 of them, you get the 3rd free. So it's not even a discount on the 3rd one. We're giving the 3rd one away, or including it as free as part of this package. So it's a great deal just from that start. If you find you like 2, the 3rd one's included. It includes real-time position or trade alerts. And if you're not familiar with what I mean by that, by position, some people are looking to take a position when we get an alert as to, in terms of taking action on a position we're going to take. Some people are looking to take a position from a long-term perspective. Other people are looking to trade it. And that trade might be a couple of weeks, maybe a couple of months. Regardless of how you use our research, and that's completely up to you. It's the same research, but you decide how you want to employ it. Positions tracking reports included with this, so you can keep track of the positions that we're suggesting, one-on-one support. And when I say one-on-one, I mean, if you need to discuss your particular situation and needs, we'll get on a phone call, you and I, we'll go over your situation. I'll get on a go-to-meeting. We'll look at different things together and make sure that we match up what research is right for you. But when you are already, you become a subscriber, I should say, I'm there to help and support you as well. So it's not just someone answering the phone and we're answering an email back, but if you need to get on the phone and we need to go through things, I'm there for you. This also includes occasional premium content and also delayed access to premium webinars. So from a value perspective, this by far is the best value for the buck because of what we include with the weekly combo. And here's who benefits, if you will, specifically from the combo when you break down the different research that's included. Our global trends research is really great for those looking for a 30,000-foot view of the world. They want the pattern and trend analysis of the global market indexes, and that's what we provide there. Also, it's perfect for anybody who really desires limited trading. Maybe you can't trade a lot because you don't want to. You're a financial advisor. You're looking to take long-term positions, so you need that big picture perspective. That's what Global Trends provides. Others might have restrictions in 401k or company retirement plans. Again, Global Trends is a great resource and solution for that need. The second report is our sector commodity. That's where Chris shares pattern analysis and alerts on breakouts and reversals in the sector and commodity space. So again, it's not only the pattern analysis, but this one includes real-time alerts that are sent to you by email as they occur. And then our metals, same thing, chart pattern analysis and real-time alerts. But in this case, it covers gold, silver, copper, steel, and the miners, and on a weekly basis. So every week you're getting these reports, but as real-time alerts take place for sectors and metals, we're sending you an email as to the action we're taking. So let me give you an example of that. When we send out a trade or position alert, in this case, let's say in the subject line, you're going to see taking action. And we're going to tell you what we're buying, but that's the key in every email is a taking action email. Then in the body of the email, we list the position name, in this case, Apple, and the symbol, the initial stop that we're suggesting to take, the position size. Now, position size is completely up to you and how you manage your portfolios. We're just going to share what position size Chris is taking in this case. More likely than not, if it's a very aggressive trade, like we just had, a pretty strong sell-off, a pretty strong reversal. So in this case, Chris decided to take a quarter position in Apple and Google and a few other things. You can fully decide what position you want to take. We're just going to share what we're suggesting. And then the last piece in the body is the comments. Comments are going to be brief. And as you can see, in this case, this is the extent of Chris's comments on when he was buying Apple. Now, there's a couple things behind this. One is the idea and the goal is to get the alert out to you right away, not to write a long dissertation on what we're doing and why we're doing it, and delays that action. But the other one is the power of the pattern is what drives our decision making, not a bunch of commentary, not fundamental analysis, not that there's anything wrong with that, but we are the power of the pattern shop. When you think of technical analysis, when you think of making investment decisions, if you're looking for pattern analysis to help you make that decision, that's what we do every day, not write books or long explanations. So in this case, you obviously see Apple, and Chris explained it, I think, earlier. Here's a support line. The channel drawn here is a second support line. In 30 seconds or less, we hope you can see that there's two support lines, and there's an opportunity to buy with a stop right here where the red line is to keep your risk low. So there's an example of a trade alert. Here's an example of a summary of positions that we had at one particular time, and you can see what's included. A lot of different information here. If I can highlight a couple things, we're going to list obviously the asset, the sector that it's in, again, the position size that Chris is suggesting. A lot of times we'll take a half position if we find ourselves with several different positions. The position remaining, when you see that just means we sold some along the way. And yes, we alert you to if we sell a certain amount of the assets, we take some pocket change, as we call it, you're going to be alerted to that. And if we raise stops, you're going to be alerted to that. So for example, you'll see initial stop here. Well, over here it says current stop. The difference is if we, in fact, along the way, the asset's moving in our direction, we're going to move stops up to protect those gains. And that's why you have two different stops here. And again, we email that stop or an update to you. Current price and of course gain or loss in the position when we got in, you'll also see. And let's see if we can get to the next slide here. I think I have to get out of this to do that. So we just went over this. It's sent twice weekly, and also it includes closed positions for the last 30 days. And that's just a nice thing to see, to compare how things are going in your portfolio versus how we're doing. We are first and foremost providing pattern analysis to you. The trade alerts, the trading that we do is just to provide you an example of how we're trading, but we certainly recognize and appreciate that each of you have different ways you trade things for different time frames, different goals, different vehicles. We're going to provide an ETF or an individual stock symbol in 99% of the cases. Options, futures, many of you use our research to trade options and futures and have had great success. Though we don't provide that, does not mean you can't employ it with our research. It's worked very well for many folks. All right, so now we're going to get to this special offer here, and I'm going to go through a couple of things. Again, this offers to the first 61 subscribers. We're going to add 6 months to your membership free. Now, what is that membership? It's an annual subscription to Weekly Combo. So when you subscribe to our Weekly Combo, to not a monthly, but an annual subscription, we're going to add 6 months to it. Now, this is to the first 61 subscribers. Earlier in your chat box, and I'm sending it again now. I don't know if there's another way I can send this, but hopefully you'll see it. But there's a link in the chat box, and that takes you, should take you directly to our checkout, which I'll share with you in a second. But if this research is something that you want to employ from what you've heard, this will add 6 months free to the end of it. This is good for the next 38 hours. We can't obviously offer it forever, and it's a unique time, as Chris shared, in the business. And so we're going to be making this offer in the next 38 hours only. And when you add up the amount of research we're giving away, this is not a value like when you see in some webinars, how much the research is worth that they're going to give away for free. So this is actually $49,000 worth of research that normally someone would pay for. We're going to give away for free. So,
hey Rick, just for a second, I just wanted to jump in and just say, folks, as I tried to make the case, I believe multi-decade opportunities are in play. We've never offered anything like this before. Right now, it's a one and done deal. But I just, in my heart, I feel it's that important of the type of situation that we're in, that I want to do this. I want to try to help. And I think the opportunities, because of these inflection points in the multi-decade channels, it could just be really important and opportunistic. So again, we hope that you can, with our guarantee on money back, just hope that you'll try to take advantage of these opportunities, and we're excited to share it. We really are. Thanks, Rick.
Thank you, Chris. Some have asked if they're already a Metals member now. Say you're a monthly Metals member, and now you want to be a weekly combo annual subscription. Yes, we'll figure that out. But if you subscribe, you're one of the first 61 to subscribe to the annual subscription to weekly combo. Yes, we'll prorate the metals that you have, and then we'll add 6 months onto that. So we'll figure that out. But the answer is yes. The other thing too, I want to make sure that everybody is aware. After you just subscribe, we're going to add the 6 months. It doesn't happen immediately. So after someone subscribes, then I'll go back and I'll look and then get back to you and let you know that the additional months have been added to it. We just have to do it manually. But per person, if you haven't already calculated, it's 800 hours worth of free research that we're going to add for you on the back end. Here's the other thing. Of all that we said, you're not 100% sure if the research is for you at this time. Just understand that when you subscribe, it's a 30-day money-back guarantee. And so if for some reason you subscribe and it's just not what you were looking for specifically, we do offer a guarantee for 30 days. And hopefully that's a good enough time for you to evaluate. You'll get 4 reports. Actually, you'll get 12 reports with the weekly combo. Each week you're getting 3 reports. You're getting some action alerts. So plenty of information to absorb over that time to make your decision. But we certainly, and you can change or switch at any time. If the weekly combo just isn't for you, then and you need to switch to an individual, great. If you want to upgrade to premium, you have that complete flexibility. It's included, this guarantee is included with all the research that we offer. So makes the decision truly risk-free with this guarantee. All right, website homepage, just to give you an example, if you went to our website, the homepage, as you scroll down, will show the weekly combo. You would just simply click on weekly combo to get started and to subscribe. The link that I gave you in the chat box will actually take you right here. It'll take you to the billing. You'll click on annual and then add it to cart and then subscribe from there. So that's how you would do it, just using the link that I sent. Otherwise, if you're on the home page, you scroll down and get to weekly combo, you can subscribe through there. KimbleChartingSolutions.com is our home, the website name, and it'll take you right to the home page. Couple things. I don't know if Chris, if there's anything else you wanted to share. I wanted to cover one thing. For those of you who are new to Kimble Charting, we've had well over 1,000 people register for this, wanted to register for this event. We're very honored by that. But at the same time, we recognize there's some new folks who are just beginning to understand or get exposure to Chris's research. So I just want to give some quick examples of how we try to empower members to succeed with the research. First of all, providing you concise, timely, and actionable pattern analysis and trade alerts to your inbox. A chart like this with the pattern, very simple and in no time you can see what the action is to take. That's our goal every day, to provide this stuff to you so you can take action on it, and we deliver it to your inbox. That's goal number one. Goal number two is providing you high probability breakout and reversal opportunities in these different types of patterns. These are our favorite bull patterns, for example. Ascending triangle, there was a lot of them last year. And we took advantage of several of those, but bull flags, cup and handles, bullish pennants are certainly plenty of those as well. And these are some of our favorites on the bull side. On the bear side, we haven't seen a lot of these yet, but you know they're going to come, rising wedges and bear flags. These are some of our favorite patterns on the downside. So these are what we're looking for every day. Goal number two, what we're trying to provide for you and look for you on a daily basis. Third, if our research is doing the job, it's saving you time. We really truly believe that when you look at that pattern, it takes you about 30 seconds to figure out what that pattern is saying and the action to take. We know people are busier and busier, and you just don't always have the time to do a ton of research on the fundamental side. And if anything, even if you do the research on the fundamental side, this really is designed to help you make clear the time to entry and the time to exit. It's not always clear, if clear at all, on the fundamental side. Goal 4, with our research, at the end of the day, you better report to me that you have greater confidence when it's time to take action, or we're not doing our job. But every day with the pattern analysis Chris provides, it's clear, concise, and we really believe, and then we hear it from you guys, that you have greater confidence. 5, when you look at the patterns, all the other noise should be blocked out. All the stuff you've read, everything else, this is I think the type of research that really helps you hone it down to a final answer. And it's like this golf course, nice and peaceful, nothing in your way, no distractions. There's the pin, go for it. That's the goal of the pattern and the power of the pattern. And then last goal is we help you manage downside risk. It's one thing to take a position, it's another to know what your stop loss is, what's your downside risk. We share a stop with every single position. You decide what stop's best for you, but we're always focused on minimizing the downside as much as possible. So just know that that's a big goal for us, for you. A couple of things people have said just from a customer's perspective, how they view our research. In this case, the deciding factor for Michael was simple, easy to use, easy and to understand approach, clear information, and results. He made money. Obviously, all of those things are important, but he shared very simply and succinctly how he's benefited from the research. John's a financial advisor, has been with us for some time, and we were really tickled when he shared his email with us, that he said he was added to Forbes' list of top advisors in 2017 thanks to Chris's research. Can't get a better compliment than that. And a couple of comments that he made below about why the research is important for him. It's gives him a great macro view of things. Again, what I talked about earlier, I'm not making this stuff up. We want this to really crowd out the noise, minimize the noise, and it's from his perspective, he's sharing that it's helped him to do that. And then the technical bullet points that he can share with clients is of great help. So to wrap up, here's the offer: 61 subscribers, 38 hours, 6 months free, weekly combo at $12.97. We're going to add that 6 months on it to the first 61. We look forward to the opportunity to serve you guys. Just remember that money back guarantee is there. And if you have questions, we're here to help at any time. And I think, let me just see if there's anything else that, there we go, the contact screen. I want to make sure, let me back up one. Again, in the link or in the chat box, we put that link. So that's how you get directly to this screen if you want to subscribe. And then if you need to contact us, there's our email address. There's our toll-free number, international number if you're calling internationally. And how to follow us on some of the social channels. We have lots of followers on Twitter, but also StockTwits, and YouTube's a great resource if you want to check out our videos. Chris, you still there? Want to wrap up?
I'm still here, Rick, and thank you for a large percentage of the people that hung with us through this and through the whole meeting. And this isn't a sprint. Like I said, this is my 38th year, and I may be 61, but I hope that many of you on the call today that I could get to know, and that we could have a conversation when I'm 71, and we could say, boy, has this been a fun ride. I've been in it for the long run from the very beginning, and I think the Lord for being blessed. I'm here in good health and having a great time, and I've never found it more exciting. And I think the opportunities, everybody, are really great. There's several trains that are going to leave the stations, and we want to help you be on board that and be of service to you. So thank you, everybody. Thank you, Rick. Appreciate you all.
Chris, I'm going to leave this presentation open so I can answer some questions that folks might still have before we leave. So let's keep it open.
Sounds great.
For anybody still on this call, if you had questions about the book, it's called Extraordinary Popular Delusions and the Madness of Crowds. Not a short title, but Extraordinary Popular Delusions and the Madness of Crowds. If you didn't win it, you can still go out and get that book, and it's a must read regardless.
By Charles McKay.
Yes. Thanks, Chris. Charles McKay is the author. Yep. I might as well answer some of these other questions while people are still on. You're asking if we cover Bitcoin. The answer is on occasion. Chris has highlighted it, but it is not part of our products right now where we're covering it in any consistent way. But we have shared some of the best couple of charts out there because Chris shared the long-term perspectives. Even though Bitcoin hadn't been around forever, it literally hit the top of a channel that Chris has drawn from when it started. I don't know, it was 2010 or whatever. And right off that channel, it reversed pretty strongly. In fact, very, very strong. It was down like 60 some percent. So, but we don't cover it consistently. Again, some other questions here. Just some of you are going to, of course, answer offline. Somebody's asking, of course, the premium service, what's the difference between premium and the other products? Premium's everything we produce, which the main difference is going to be the number of opportunities that we share, the amount of pattern analysis and the number of trade alerts and opportunities, breakouts, and so forth that we share with you are going to be many more times what we're sharing in the other products. And so that's one major difference. The other is, on occasion, if you have an asset that Chris doesn't cover, we'll provide pattern analysis for you on it. It's not something we could do. A lot of them, it's not something where if you call every week or email us every week, could we do one for you? No. But one or two a month or something if they come up and we aren't covering it. So that's some custom research, in effect, that we're giving away as part of premium. And of course, any live webinar that we do, premium members get the benefit of that. And if you're in our other products, if we send it out at all, it'll be delayed. What else? A financial advisor is asking if we have any trademark policies regarding sharing our research in a small office. And that's from Charles. Charles, might need to talk to you about that. We don't have any problem with sharing our research with your customers, with your clients. And if it's in your immediate office, typically like one or two other advisors, we will say yes, we agree to that. But let me find out more about the facts, see what you have in mind before I commit, right? And so I can talk to you a little bit more about that, Charles. If some people, again, are asking about the copy of the slides, if you want a copy of these slides that we presented today, I'm going to send them. I can send them out. Just send me an email. And that email is It's just it's plural, services@kimblechartingsolutions.com. Happy to send them out. Bruce Powell, nice to have you aboard. That's great. Very honored that you've decided to become a member. So John Milo, I think it's Milo. I hope I got that right, John. And yes, you are one of the first 61. So very honored and to have you aboard as well. Let's see if there's anything else. We're going to wrap up again. If you guys have some questions and you're willing to hang in there, I'm willing to hang in here and just answer. Let's see. Yes, again, for those of you who arrived late, yes, it's being recorded, and I'm going to have to do a little editing in the record. In fact, I'll probably